Recently, it has been a turbulent time. Ukraine, the inflation, the rising rates. But in these times, we ought to be level-headed. Did the fundamentals of the business change? Is the war in Ukraine going to affect your investment? If yes, by how much? For how long? How significant is this impact going to be 10 years down the road? For Tesla, is 4680 battery able to scale? Is the progress on FSD slowing down? Is the demand for EV decreasing? In fact, if anything, the demand should rise as the world tries not to rely on oil. For Palantir, is commercial sector growing at 100%? Is Palantir growing at 40% for the next 3 years? Is data integration and big data the future trend? Is Palantir the only provider? In this current climate, Europe will realize they need cybersecurity more than they initially thought, especially when the enemy is next door. Price movement is only short-term. Long-term, the value of the business will always reflect itself. 80% of the trades are made by algorithm. They trade based on momentum, not value. But for us, as individual retail investors, the better strategy is to buy great companies and hold for the long term, unless fundamentals change. Probability-wise, your chance of winning and the amount you win will always be higher over short-term trade that tries to time the market. I will link this article in the description. Even God can't beat dollar cost average. 8 out of 10 times, the market is a bull market, and in the long run, the US economy is always on the uptrend. Unless there's a nuclear disaster or Thanos snaps his finger. Before I invest, I always, number one, set the criteria for the business I invest in. If they accomplish this, okay, I stay invested. If they fail on any of the criteria, then I monitor. And number two, I have a price target of the company. How much is the fair value of the company? And at what price will the company go to in 5 years' time? Tesla and Palantir, they are still meeting this criteria. You can check out my previous video. I will share the link in the description. Now, about the US debt, printing too much money, inflation, and the rising interest rates. I will share what I learned from CFA lecturer Dr. Mark Meldrum. This is based on what I understood. Market conditions may change, so don't take it as it is. This is not a suggestion to act in any direction. Ultimately, you are responsible for your own investment. On the US debt, printing money, it is not as a big deal as most perceive. I will share why. The US has 30 trillion debt. 50% of the money in circulation is created in the last 18 months. It looks scary, but let's break it down. Of this 30 trillion, 6.4 trillion is federal trust fund, government account. It's basically government owing money to itself. So, basically you're left with 23 trillion to pay. However, of this 23 trillion, 5.4 trillion is owed by the Fed, meaning to say it is a left pocket to right pocket thing, just to provide more liquidity. You're not getting richer nor poorer by this. So, the net debt to be paid is 18 trillion, which is around 80% of the US GDP. It is high, but it's not end of the world or no turning back kind of high. The US economy still has the ability to pay this debt. On the net interest outlay, this is the affordability of the government to service the debt. If your salary is 10,000, you buy a MyV, it costs you 56,000. Assuming the interest rate is high, you need to pay $1,000 a month. You're spending 10% of your salary to service this debt for MyV. However, now you buy a Toyota Corolla, which costs you 150,000. The interest rate drop. You are only paying $800 a month. So now, you're spending 8% of your salary to buy a Toyota Corolla, which costs 3 times more than a MyV. Even though your debt amount has increased, but the affordability, the ability to pay the debt has improved. This affordability, this ability to pay is called the net interest outlay. The net interest outlay in US is 1.3% and will remain below 2% for the next 10 years due to low interest rate. This is lower than the 3 to 3.5% in the 80s, which causes more financial strain to the government. On inflation, inflation is supply and demand. In a river, on the upstream, you have the water flowing in. This is the supply. On the downstream, you have the settlement that uses this water. This is the demand. If you build a dam on the upstream, very little water will go to the downstream, to the settlement, and hence the prices of water will go up. The current inflation is more likely caused by constriction of supply and manpower than it is due to monetary supply. Because, as I've shared earlier, the US debt is not as scary as you think. Raising interest rates may only help so much, as the rate is related to demand side of the equation, not the supply side. The true solution to dealing with inflation is the ease of restriction when the pandemic subsides. The war coming in, it will further complicate things, it will further constrict the supply, it will cause higher inflation and worsen things. But taking the war aside, the economy seems healthy and is not in a dire state that most people think it is. Lastly, on the economy, on the high yield credit spread. A spread is a difference between a yield in high-risk bond and a low-risk bond. A high-risk bond offers high yield, but the chance of default is higher. A risk-free bond is typically issued by the US government, and hence the chance of default is very low. In a high-risk environment, the yield of high-risk bond will increase because investors need to be compensated for the additional risk that they take. For now, the high-yield credit spread is still low, but we will monitor. For building permit, it is a leading indicator of the housing sector and the economy, because you need a permit first before building. A building permit is on a positive trend and hence indicating a growing economy. US unemployment is also decreasing, means more people has work. People spend more money and thus boosting the economy. Because there's more manpower supply, this will also reduce inflation. One thing that will help with the economy of my channel is to hit the subscribe button and hit the bell notification. The YouTube algorithm is not my friend, so your support will help keep this channel alive, so that you can learn more about finance and macroeconomic content like this. Now wrapping up, the market is volatile and we are likely in bear market. It is difficult to predict the direction of the market and when it will happen. Now is not a good time to leverage as interest rate will increase. But not staying invested is stupid either, because your money will lose value. My brain is simple. I will hold Tesla and Palantir for the next 10 years and dollar cost average unless fundamentals change. The stock price may be down, but if the business is doing great, fundamentals don't change, I will stay invested. This will be a difficult time and we may be affected emotionally. But it's during this time that we make decisions based on facts, not rumors or gut feel. Take care, invest safe.